Hello, I'm Allison Schrager, a senior fellow at the Manhattan Institute, and welcome to our event brought to you by the Shadow Open Market Committee. The Shadow Open Market Committee, under the auspices of the Manhattan Institute, is an independent group of economists that provides external perspectives on policy choices by the Federal Reserve and other leading central banks. The SOMC addresses a wide range of macroeconomic issues, including monetary policy, banking and financial regulations, and fiscal policy matters that bear on monetary policy decisions. And today we have a very important discussion, which I would say are all the things that are the most important things we're not talking about when it comes to central banking. And that is Fed governance, accountability, and transparency. Now, these might sound like technocratic issues, but they are becoming more and more important as central banks are quickly expanding their role, both with the last financial crisis and the current crisis. They're buying all sorts of new assets, taking a larger role in regulation, and just in general, a larger role in the economy. And there is serious concern that this could diminish central bank independence, and independence is exactly what gives the Fed its power to do its job. So maintaining independence largely does come down to governance, accountability, and transparency. And there are many questions about how can we retain these institutions as the Fed expands its role. So to kick things off, our first panel will be moderated by Gregory Hess, the president of Wabash College in Indiana. And Hess, in addition to a distinguished academic career, also served as an economist at the Federal Reserve Board in Washington, and has been a visiting scholar at many different central banks and the IMF, both locally and all over the world. And he is an expert in macroeconomics, public finance, monetary policy, and the political economy. So I'm going to hand this off to Greg so we can dig in.
So thank you very much, Allison. On behalf of the Shadow Open Market Committee, let me extend our thanks to you and to the Manhattan Institute for hosting today's event. It is my enormous pleasure to moderate this afternoon's first panel that examines critical issues pertaining to the governance of the Federal Reserve System. For this 45-minute session, each speaker will be given 8 to 10 minutes for their presentation, and I will allow 1 or 2 brief follow-up questions for each presenter as time allows. I will introduce each presenter in turn. After each panelist has presented, I will open up the remainder of our time to further questions and discussion. Our panel begins with a distinguished guest to our Shadow Open Market Committee meeting, Professor Kathryn Judge, who holds the Harvey J. Goldschmidt Professor of Law at Columbia Law School. Professor Judge is an expert in multiple areas, including financial regulation, regulatory architecture, and central banking, exemplified by her important scholarly work, her position as the editor of the Journal of Financial Regulation, and her membership on the Financial Stability Task Force. Today, she will be speaking on why the Fed needs a credit policy framework.
All right, Greg, thank you very much for having me and for that introduction. So I'm going to start with basics that we all know but are worth revisiting. Central banks enjoy a degree of independence that is unprecedented among government agencies. There are very good reasons to have central banks more shielded from direct political oversight, but this, of course, raises fundamental issues regarding accountability and transparency, as we've already started talking about. One of the ways that the central banks, including the Fed, have traditionally dealt with this challenge is by using policy frameworks. Policy frameworks are not legally binding, but they do set out in relatively clear terms what a central bank plans to try to accomplish and how it thinks it's going to accomplish that. And so what it does is it enables the public and other policymakers to know what to expect from their central bank. And it also allows them to hold the central bank accountable if it acts in a way that's contrary to what the framework might expect. So there's a couple of areas where we've seen the central bank invoke these types of frameworks. One, where it's actually quite informal, is in the Fed's role as a lender of last resort. So here, the classic framework that the Fed has used when stepping in as a lender of last resort is bad debt dictum. And we're not going to go into the details here, but the critical elements of bad debt dictum is, first of all, it tells the public what central banks should do. And that says in a period of systemic distress, that central banks are going to step forward, that they are going to provide liquidity. It says who they're going to work with, anybody who's solvent and who has good collateral, And it also provides limits. We need to make sure not only that they're solvent and they're good collateral, but that those loans are being made at penalty rates relative at least to what would happen in normal terms. So there's a lot of flexibility built into this framework, but it does at least provide a central understanding of what central banks are trying to do. And in the last financial crisis, we saw Bernanke invoking it very early on, starting in the fall of 2007 throughout the crisis and afterwards. It was used to justify some very controversial decisions, including the decision to go from not just providing liquidity to the banking system, but also providing widespread liquidity support to the non-bank market-based system of intermediation that it had developed. It was also used to justify decisions like the decision to support Bear Stearns and not to support Lehman. Those decisions have been challenged by many, but interestingly, very often, even the challengers are using bad dictum. They're saying, no, Lehman was solvent, so you should have made a different call there. And that in and of itself provides a framework for understanding, okay, was this a legitimate decision? Was this the right decision for the central bank to make? Another example where, of course, it's subsequently been far more formalized is in monetary policy. So we saw the Fed traditionally had understandings of what it was trying to achieve and how it was trying to achieve it. And then in 2012, it actually formalized this in its initial framework. Then in the late fall of 2018, they said, you know what, the economy isn't working quite the way we thought it was going to. And we also have some new understandings that we'd like to feed into this framework. So they opened it up for what they've self-declared as the first public review. They held also a whole variety of events, these Fed Listens events. And the idea here was to make it so members of the Federal Open Market Committee, the FOMC, really traveled around the country and heard from groups, from constituencies with whom they don't normally engage. And so they had then a broad set of data points, including new information, to go back and revisit the framework. And of course, we saw that when it came out, I think we'll hear more about it soon, that in and of itself coalesced public attention on what is the Fed doing and why is the Fed doing it. So how to play out, again, remains unknown. There are plenty of questions that are still lingering, but at least we have a framework in which we can start to debate, is this what the Fed should be doing? Is it not what the Fed should be doing? Why and are they doing what they purport they're going to do in a given set of circumstances? So now let's turn to what has been the most controversial area of the Fed's actions in this crisis, and that's credit policy. And credit policy has meant different things at different points in time. But I think here we can understand credit policy effectively as efforts by the central bank to try to support lending to the real economy. It doesn't have to be sector specific. It hasn't been sector specific, but it is specifically designed to try to make sure that there's access to credit to particular sectors in the real economy. So we saw the Fed, even before the CARES Act, indicate that it planned to take actions in this area. They announced on March 23rd the creation of corporate credit facilities. As soon as they announced that, we saw a massive decrease in the amount of the credit spreads in those areas. And then we also saw that they announced that they were trying to try to do a Main Street lending facility to be able to provide more liquidity, more loans for companies that were part of the mid-sized companies that can't quite access public markets. And not surprisingly, very shortly after that, we saw that actually this was probably the byproduct of actions that had been taken by Congress. And so Congress in the CARES Act said to the Fed, work with Treasury, here's $454 billion. We want you to lever it up significantly. And what we expect is for you to provide a lot of very meaningful support to all kinds of different entities in the real economy. You know, here we are a little over 6 months later, and only a fraction of that $454 billion have been used. The Fed has created facilities, both the different corporate credit facilities. It's expanded on the Main Street lending facility. It has a number of different fronts. It's expanded to nonprofits. It's expanded to municipalities. It's changed the terms of all of these different facilities. Nonetheless, the usage remains remarkably low. Again, in the corporate credit space, just the announcement had very significant effects. So when we look at the big picture now, we've seen that large corporations have even more access to financing than they did previously, but mid-sized corporations are still struggling, smaller corporations are still struggling, nonprofits are struggling, municipalities are struggling. Does this mean the Fed should be helping these? I don't know. I think it's a very, very difficult question. I have to admit, I was very skeptical very early on, and I was not alone in being very skeptical early on that the Fed was in a position to help these companies. But one of the challenges is that Congress didn't know that when they gave the Fed this money. And I think this really came out in the most recent testimony last time Chair Powell visited the Hill. We saw on the one hand him saying, oh, we're still facing a lot of struggles. This is a really difficult time, but we're doing everything we can and we can't do a lot more. And lawmakers from both parties, this was not a political difference, from both parties said, you have all of this money, why aren't you using it to do more? And again, I don't think there's an easy answer there. I think one could very well say that really we want a central bank just to be a lender of last resort, to focus on monetary policy, and it shouldn't get engaged in the space. But then we would have needed a very different presentation to Congress over here's what we're able to do and here's what we're not able to do. By contrast, you could say that maybe the Fed should be more involved in trying to provide more meaningful support to other sectors of the real economy. But then we would need to build out the infrastructure to do that. We'd probably want to change pieces of the law. Things like the Fed's inability to loan money to bankrupt companies would make less sense if they're going to play a role supporting the real economy, because actually protecting the underlying company through a restructuring might be exactly what the Fed should do if it had a credit policy. So I have a lot more to say. Of course, this is going to be a long-term process, but the COVID crisis is far from over, and I have doubts that it's going to be the last time, even exogenous shock, that's going to push the Fed into the space. So what we really need to do at this point is start to have a framework so everybody understands, here's what the Fed thinks it can do, here are the limits of what the Fed can do, and that can animate the actions going forward. Thank you.
Well, thank you very much, Kathryn. Let me just start off with just one quick question. So, it appears as though the Federal Reserve has done a better job on the kind of forcefulness of its response on the front end. Do you think that the Federal Reserve in this crisis has gotten the politics of it a little bit better as well?
You know, that's a really interesting question. They might have gotten, I think one thing, they had a much broader set of tools at their disposal. You know, the Fed was slow to act last time around, partly because it was slow to develop these tools. So we did see this beautiful and I think very effective aggressiveness in March. But then when it comes to actually the implementation, it's taken an incredibly long time. And so I think there's two faces to the politics. One is saying, I hear you. And one of the things they've done a great job with, and they used even when they're doing the new framework, is we care about unemployment. We care about the unemployed. That's what's going to motivate everything that we're doing. But I do think whether or not they're able to maintain that longer term is going to depend. And so if we see the structure of the economy potentially impacted by where they managed to provide support, even if they weren't giving money out, in contrast to areas where they weren't, whether or not they'll be able to continue to ride the smooth political ship that they've been on so far, I think is something we'll have to wait and see.
All right. Well, thank you so much. We now turn to Shadow Open Market Committee member Athanasios Orphanides, professor of the practice of global economics and management at the MIT Sloan School of Management. Athanasios has held many important roles at the Federal Reserve Board and has served as governor of the Central Bank of Cyprus and has been a member of the Governing Council of the European Central Bank. His topic today will be interpreting the Federal Reserve's mandate, a legitimacy challenge.
Thank you, Greg, and thanks for this introduction. So my talk is motivated by the recent change in the Federal Reserve's policy strategy. And what I wanted to do in discussing this is go back and ask the question, what is the Fed's statutory mandate? What exactly is it? Not what they're telling us it is in one statement or another. Then explain how the Fed is now interpreting it and comment somewhat on how this interpretation has changed over time. So again, I'm going to focus on the statement on long-run goals and monetary policy strategy that has been announced in August. Let me take you back to Section 2A of the Federal Reserve Act. Now, this is from 1977. I want to remind you, Fed chair in 1977 was Arthur Burns, And Section 2A describes the monetary policy objective. Let me read this to you. It's only a few seconds, but it's useful to keep this in mind. It says, quote, "The Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production, comma, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates." And this last part of Section 2A is what the Fed has focused on in its recent policy descriptions. Now, the Fed has had difficulties in interpreting this language literally over the years. Those of you who've been following previous SOMC meetings know that we have discussed this in the past multiple times. The Fed's mandate is not the simplest one to follow. It's quite complicated, so it has to be interpreted in a manageable way. Now, one major difficulty has been to define price stability, and on this front, I think we need to give a lot of credit to the Fed for already in 2012 taking a very positive step in providing a numerical definition that can help keep the Fed accountable for what it's doing with respect to price stability. In its recent statement, the Fed actually has strengthened in some respects this aspect of its description of the goals by emphasizing even more the role of well-anchored inflation expectations. So what they said in particular, the most recent statement is, quote, "The committee reaffirms its judgment that inflation at the rate of 2% as measured by the annual change of the price index for personal consumption expenditures is most consistent over the long run with the Federal Reserve statutory mandate." And they added, "The committee judges that long-term inflation expectations that are well anchored at 2% foster price stability and moderate long-term interest rates and enhance the committee's ability to promote maximum employment in the face of significant economic disturbances." And frankly, this is very good, and I wish they had left it at that. The problem is that they didn't. And what we have in the August statement is unfortunately opening the door for systematically overshooting the inflation goal, which creates some risks. And let me explain where those risks come from. They come from the Fed's interpretation of its other goals. Now, this goes back to the statement in 2012. A very negative aspect of the 2012 statement involved the reference on maximum employment that, as I mentioned, comes directly from Section 2A of the Federal Reserve Act. Now, what does maximum employment mean for the Fed? Well, it's actually not clear what it means for anybody. You can always have a little bit more employment at any point in time by overheating the economy. So this is kind of one of those things that are very difficult to deal with. Trying to make sense of this, the FOMC in 2012 effectively adopted a Phillips curve model approach and referred to the longer run normal rate of unemployment. The estimate of the concept that would go into an empirical Phillips curve is what they meant with maximum employment. Now, this is how they dealt with the problem in 2012. It was internally consistent, but of course it has a problem. Not everybody accepts the Phillips curve as the most useful way to think about policy or even to forecast inflation. And as we know, Phillips curve-based forecasts of inflation, which are notoriously unreliable, proved even more misleading than usual over the past several years. So what to do? How to refer to maximum employment? The suggested answer that I read in the August statement appears to be just resort to linguistic gymnastics. Let me just read from the statement what the statement now says regarding maximum employment. Quote, "The maximum level of employment is a broad-based and inclusive goal that is not directly measurable and changes over time owing largely to non-monetary factors that affect the structure and dynamics of the labor market. Consequently, it would not be appropriate to specify a fixed goal for employment. Rather, the committee's policy and decisions must be informed by assessments of the shortfalls of employment from its maximum level recognizing that such assessments are necessarily uncertain and subject to revision. The committee considers a wide range of indicators in making these assessments, end quote. So what does this say exactly? It says, number one, maximum employment is not measurable. So, number two, policy will be informed from assessments of shortfalls from this unobservable, unknowable maximum level. This is one peculiar description of a strategy. Let me try to repeat for clarity to the extent this is possible. To fulfill the goal of maximum employment, the Fed's monetary policy will be informed by a range of indicators, which are not articulated anywhere in the description of the strategy, that will measure a shortfall from something that cannot be measured. Let me just say, using Washington, D.C. language, this is not particularly helpful. Now, do linguistic gymnastics like this make policy more systematic, which is what would have been a positive step for the Fed? Hardly. They simply manifest a desire for maximum discretionary flexibility and avoidance of accountability. By saying that the policy strategy is based on an unmeasurable interpretation of an unobserved goal, informed by unknown indicators, anything goes. This way, nobody can ever evaluate how well the Fed has been doing in fulfilling its maximum employment mandate. Now, in isolation, that would not have been a problem because I don't think the Fed should have been focusing on that aspect of its mandate. What is worse is that this part of the strategy can be invoked as the reason why policy in future may guide inflation consistently above the stated goal of 2%. That is a problem. This does matter for the success of monetary policy. Linguistic gymnastics in describing maximum employment may actually compromise the hard-won progress done over the past 3 decades in restoring and preserving price stability. Now, one might ask, is there an alternative? Let me mention very briefly just two. First, a clear positive step would have been for the Fed to actually include a strategy in its, quote, statement on longer-run goals and monetary policy strategy, end quote. This has been discussed by numerous people in the past. The strategy could have taken the form of a simple benchmark rule that one could use to evaluate what the Fed is doing, could describe how short-term projections of inflation and economic activity guide the economy. Which rule? That's the Fed's job to decide. And interestingly, the Fed actually started including a few simple policy rules in its monetary policy report. And the next natural step would have been to do additional research and tell us what its benchmark rule would have been. Instead, one of the things that were not really emphasized over the summer is that the Fed decided to stop the practice of reporting on simple policy rules in its latest monetary policy report. The message, no more rules, just discretion. This is not a step forward. But there was a second approach the Fed could have taken that's actually much simpler. This is the approach that was implemented during the Volcker-Greenspan era to restore price stability. What's this approach? Simply acknowledge that maximum employment is not a useful operational description of policy and cannot be included in an operational fashion in the Fed's policy strategy, and explain that maximum employment is what the Fed can deliver to the economy when it consistently maintains price stability over time. This is why, for example, in 2004, Alan Greenspan described the Fed's policy when he was chair by saying, quote, it's about maximizing the probabilities of achieving our goals of price stability and the maximum sustainable economic growth that we associate with it, just whatever comes out of price stability. Now, the major improvement in 2012 over what Volcker and Greenspan had introduced at the Fed was to quantify price stability. This was a very, very big thing. Unfortunately, the Fed should have stayed with that instead of going backwards. Now, let me close by saying one more thing. You could say, shouldn't the Fed interpret the Federal Reserve Act literally? Well, let me remind you the first sentence of Section 2A. The Board of Governors and Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential. Well, I didn't see anything about monetary and credit aggregates or how to set policy commensurate with the economy's long-run potential in what the Fed describes as a strategy. So the Fed is already not really interpreting literally it's the Federal Reserve Act. It should at least adopt an interpretation that was as coherent and improving on what was being done under chairs Volcker and Greenspan, rather than overemphasizing, as it has been doing more recently, the unknowable concept of maximum employment.
Well, thank you very much, Athanasios. You anticipated the question I was going to ask, which was to, can you, provide some suggestions as to ways around this for the Fed? And since you've already discussed those, I think we'll just move on to the final speaker. Our final speaker for our panel is SOMC member Andy Levin, professor of economics at Dartmouth College. Andy has also held numerous senior positions at the Federal Reserve Board over a 20-year career, including special advisor to the chair and vice chair on monetary policy strategy and communication. Andy's topic today is strengthening the role of the regional Federal Reserve banks in the Fed's policy decisions.
Oh, thank you, Greg. And I really do want to start by just saying how wonderful it is to have Kate Judge with us on this panel. She's doing really important work on many of these topics, and I hope we'll see lots of more of her at our meetings going forward. You have a really important voice, Kate, and I appreciate your speaking out on these things. It's great for me to come third because actually Kate and Athanasios have already covered some points. Athanasios, I, as usual, don't always agree with each other. I think that's healthy. It's a good sign of a healthy committee to have some disagreement and range of views. What I've done is to put together a few slides. I think will hopefully be able to post these, or otherwise I'll put them on my Dartmouth webpage. But just to go through some of these things efficiently. So let me share my screen with you. Okay, so, and let me just emphasize, these are just my own views that I'm expressing here. So let's start. I just want to talk briefly about the FOMC new statement, the revised statement that they issued about a month ago. I think similar to what Athanasios said, I would probably say the current version of this statement is probably better framed as longer run hopes and aspirations. That calling it goals and policy strategy is now become a little bit misleading because the goals are not very clearly spelled out. There's a lot of latitude and leeway. Talking about, well, we have lots of indicators we look at, just doesn't help the public or ordinary people to really understand what the Fed's trying to do. And likewise, it's hard for me to see anything within the statement at all that could be called a strategy. Again, maybe aspirations would be a better way to phrase it. And I think that's unfortunate because one of the things we've learned in the last few decades is that clear monetary policy communications are critical for transparency and accountability. They're also critical for helping the public and financial markets form expectation, to understand the contingency plans of the central bank. And actually in the statement, the very first paragraph says, the committee seeks to explain its monetary policy decisions to the public as clearly as possible. And I just don't see that they've actually accomplished that in what they have so far. There's actually less clarity about the goals and strategy. Now, just to give you an example of this, Athanasios already mentioned a couple. Let me read you the last paragraph of the statement before they mention that they're going to revisit this every 5 years. They say, under circumstances in which the committee judges that its objectives are not complementary, it takes into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with its mandate. And that's it. That's the description of the strategy. When it judges it, it will take into account just complete discretion, as Athanasios said. Now, there are multiple ways that they could express a more clear strategy. I still like Peter Fisher's proposal that he made to the Shadow several years ago. Every January, the committee could approve in its organizational meeting what its strategy is going to be for the year. And that could be a simple rule, like Athanasios mentioned. It could be contingency plans using scenario analysis, or it could be, they could go back to monetary aggregates or credit aggregates in some world. The main point was to have a clear strategy that they're communicating as clearly as possible. Okay. Secondly, the statement acknowledges that the Fed's primary means of monetary policy is changes in the target funds rate. But the problem now, the reality is, the funds rate's stuck at 0 and it's going to be there for the next 5 years. The 5-year Treasury yield is 1/4 point. So for practical purposes, they're frozen in place. And I think that's a bad situation to be in. It means we're not prepared. If there's any more adverse shocks that could come from any kind of geopolitical developments around the world or something else, the Fed is just not prepared at this point and did not explain at all what it would do in the case of something else bad happening. Chair Powell said, hope for the best, prepare for the worst. And I don't see in this statement yet how the Fed is really preparing for the worst. Athanasios mentioned this here. I just want to underscore this is about the goals, which used to be pretty clear and specific, 2% target, with some latitude, of course, that you're not going to hit it every year. It might take some time to get there. But now there's a lot of hedge words. Appropriate policy will likely aim to achieve a moderately above for some time, and it's really pretty open-ended. Now, the reality is that this kind of language does not help financial markets or the public really understand what the Fed's trying to do, and the Fed loses credibility. The professional forecasters, who are the ones that follow the Fed most closely and should understand what the Fed's trying to do and believe it should be credible to them, they don't expect that the Fed's going to overshoot. They think that inflation is going to run low for the next few years and continue to run low probably through the whole decade. So if the Fed was hoping to persuade people with its new Fed listens and here's our new revised framework, it hasn't worked. So maybe they need to do something more on that. And finally, they said that they're prepared to use the full range of tools, but the truth is they've taken some tools off the table. And most importantly, negative interest rates, which is something that Michael Bordo and I have talked about in previous shadow meetings, we thought was something important they should have considered. When the Fed says Fed listens, I think Mickey Levy has said this before, they're kind of listening mostly to a relatively small group, it seems like most of the time. They should be listening more to Kate and Athanasios and to Mike Bordo. Now, I don't have much time, so just very quickly say, one of the strengths of the Federal Reserve, I think, is the regional structure. It's the bedrock. It's the thing that goes back to the founding of the Federal Reserve in 1913. Boards of directors with strong ties to local communities, bank supervisors who really understand community banks, economists on the research staff who have the freedom to engage in path-breaking research, and presidents, the leaders of each regional Fed, the CEO of the organization, who have enough independence from Washington and New York that they can challenge conventional views and sometimes cast dissenting votes. And I really admire Charlie Plosser, that he was willing to dissent, even if I didn't agree with him on some of those dissents, that he was courageous in doing so. And so these are the strengths of the Federal Reserve banks. But there are constraints on the Federal Reserve banks. One is there's a very complex voting rotation. I won't go into details here, but just to say it's incredibly confusing, and no member of the public, with a few exception of a few Fed watchers, understands the rotation. Secondly, the reality is that monetary policy is determined in DC by the Fed chair and the vice chair and the vice chair of the FOMC in New York. Okay, those are the leadership team. They decide the policy. The reality is that 11 of the 12 regional Fed presidents only vote occasionally, and they're at the margins of the decisions. And even more important, they have no vote at all on other major policies of the Fed. Interest on reserves, emergency lending programs that Kate mentioned, financial regulation, all those issues are settled in DC by the Federal Reserve Board. So I'm going to skip over the Main Street lending program and just say, what's the bottom line here? I think the key reform that needs to be made to the Fed soon is to make the Fed fully public. Every regional Federal Reserve Bank should be a public enterprise where the directors of it are appointed by elected officials, not by commercial banks. That's really 100 years ago when the Federal Reserve Banks were mostly serving the banks in their district. The Federal Reserve Bank should play a key public role, and that should be understood and clearly recognized in the structure of how they work. They should be subject to FOIA and the IG oversight. And most importantly, every Federal Reserve Bank president should vote on every Fed policy decision, every decision. No more rotation. Every FOMC decision, every financial regulation decision, every emergency credit decision should be voted upon by all of the 12 regional Fed presidents, as well as the Board of Governors in DC. So I'll stop there.
Well, thank you so much, Andy. Let me just ask you just a quick follow-up question. If, in fact, the Federal Reserve System did go to a model where, Federal Reserve Bank presidents were, included in each and every decision, and they were able to vote, is there something we might observe? Is there something you could point to? Is there might be something that we can observe as a change that you think would jump to everyone's mind first to what we might be able to see coming from this type of change?
Well, I think maybe I can connect this a little bit to a question that you asked before to Kate, and I think it came up with Athanasios. The problem 10 years ago was the Fed was perceived as mostly serving serving Wall Street and not Main Street. And I think the reality right now is that's exactly what's happened this year. They were very proactive with commercial real estate, right, and with money market funds and with commercial paper. And they even started buying corporate bonds, and all of that, was rolled out very quickly. And the Main Street lending facility, it's in my slides. They promised, as Kate said, they promised that it was going to be, up to $600 billion. The reality as of today is it's $1.5 billion. Essentially, didn't get off the ground 6 months later. And so I think as people look back at this, they're going to see the same thing as in 2009 and 10, which is despite the Fed's language, which sounded good, the reality on the ground is the Fed made immense efforts to move rapidly and get things implemented to help commercial real estate and corporate bonds and commercial paper. And the Main Street stuff is just kind of sitting there frozen. And so what can they do? They need to do something urgently to get on the right track here.
That's certainly very, very helpful, Andy. Maybe I ask Kathryn a question. As I said, you are just greatly admired for some of your very careful, almost forensic work in thinking through the first year of the crisis that was in and around the time of 2007, 2008, as you talk about. I anticipate at some point you're going to write another one about this time period as well, or maybe you're started on already. What kinds of things should we look forward to as part of that conversation?
I think this group nicely touched on a lot of them. And I think it was actually really nice because we were talking about the exact same issues, but from a number of different perspectives. Yeah. I think Andy's point is who feels like they are in the room and who does the public feel like is in the room when the Fed's making important decisions. And part of what's interesting is the only way we got through Congress was through this decentralized structure, but we also only made that decentralized structure work by having a very carefully calibrated 7 members of the Board of Governors and then 5 votes from the bank president. So we know where the tie landed. Everybody else gets to be president, but they aren't involved in quite the same way. And I couldn't agree more that just become this underutilized portion of the Fed. And they've been doing great work. I mean, to say they're underutilized doesn't mean they're not influential. Just the research alone. I mean, one of the really nice things is we have research not only coming out of the Board of Governors, but just particularly in the last 6 months, some really great research coming out of the various reserve banks. So they kind of are these counterbalancing centers of power that say, like, look, we have this authority, we have the access to this data, and we're going to use it to shed light on a whole variety of questions. But there's a lot more that could be done there. And I also agree with the concerns raised by both. I don't know if I'm quite as concerned regarding the new framework for monetary policy. And it really is part of what's interesting about how the Fed has almost gotten a free pass with the fact that they haven't articulated anything like that with credit policy, right? I mean, even though they both had concerns, there's at least a lot there, like probably because we knew that they were already going to be low for long, even before they issued the new statement, that there wasn't the need for any immediate change. Whereas in these other areas that are so important, we don't know what they're trying to accomplish, what they think that they're able to accomplish, or the limits of what they're going to accomplish. I think going forward, going back to your initial question, part of the reason, I don't think they've gotten a pass, but they've gotten something like a pass, is actually that Congress came in more aggressively to provide support for small businesses, support for individuals, and support for the unemployed. But as Andy was just alluding to, as we don't get another round coming in, I think some of the inequities are going to become felt in a more lasting way. And it'll be hard for the Fed not to be held responsible for some of those, at least.
All right. I'd like to see if Charlie Plosser's there. I think he has a question that he'd like to ask. You can either type it in, Charlie, or if you're on the microphone, you can ask. Charlie, can you hear me? There you are. Yeah, you're muted, Charlie. You're muted.
There we go.
Perfect.
I've used up all my time by trying to get on board here. I have a question, and I think any of the three panelists, Kate or Athanasios or Andy, can answer it. One of the big advantages in the 2008 crisis for the Fed's involvement in credit policy, and certainly in this episode, has been cited as the fact that the Fed can move quickly. And I think, as both Athanasios and Andy and Kate, you mentioned, it took a while for the Fed to get its act together, to get any of these programs up and running, and even still, they haven't been terribly successful in getting the funds out the door. My question is, why is it that Congress or governments or whatever, or the view is that the Fed has to do these credit programs? If the Treasury has $450 billion it can use as backing, the Department of Treasury can run these programs and not involve the Fed at all in private lending and intermediation. So does anybody have a reaction to that, or a view about why this necessarily has to fall in the lap? It's not really lender of last resort in the usual sense of the word. It's something different. It's credit allocation. So I just want to throw that out and get anybody's reaction to that.
Please, Kathryn.
I'll jump in quickly. I'm sure others will as well. But first of all, I couldn't agree more as a general matter. And that's one of the real challenges with the way they structured it this time, is there's an incredible lack of accountability because they all have to agree. And a nice counterpoint to that is what we saw in the ESA legislation in 2008, where Congress came in. And effectively there, Congress did write a blank check to Treasury, but with a lot of accountability built around how they subsequently use that money. And given the fact that things are moving really quickly, Congress said, basically, we have to do this, but we want ex post accountability. And that's the way we're going to balance the need for discretion, the need to move quickly, with the need to have some transparency and accountability. And I think that ended up being a much more effective program than what we've seen with the $454 billion this time.
Okay.
Can I add something briefly?
Please, Andy. Yep.
So, and again, I just very much agree with what Kate has said. So let me just try to elaborate a little bit. I mentioned before that the regional feds, oversee community banks, and the community banks have better knowledge than anyone of small businesses and mid-sized businesses. And so when the Federal Reserve told Congress in the spring, we can do this, and we can roll it out quickly, I thought it was credible. And the premise was that Congress appropriated money so that if some small businesses, ended up having to close, that default risk would be covered by the collateral that Congress appropriated. When you look at the Fed statements at the time, I'll just read one to you. April 9th, Federal Reserve Board statement. The Federal Reserve is using its full range of authorities to provide powerful support for the flow of credit and will ensure credit flows to small and mid-sized businesses with purchases of up to $600 billion in loans through the Main Street Lending Facility. That was April 9th. Well, here we are, September 30th. Not $600 billion, not $300 billion, not even $100 billion, not even $10 billion, $1.5 billion. So they way overpromised. And as Kate said, if they had just said at the time, look, we don't think we can do this, then maybe Charlie says, all right, great, give it to Treasury or SBA or whoever. Okay, but don't take on something unless you're sure that you can really insure this. And so I think it's gonna come back to haunt them.
It's going to hurt their credibility.
Yeah. Well, our time's up, everyone, but do let me thank you for what I think is just absolutely sensational first panel session. I'd like to now hand the meeting off to my SOMC colleague, Deborah Lucas. Debbie is the Sloan Distinguished Professor of Finance at the MIT Sloan School and Director of the MIT Golub Center for Finance and Policy.
Great. Hello, everyone, and thank you, Greg. It's my great pleasure to briefly introduce Sir Paul Tucker, who currently serves as a chair of the Systemic Risk Council and who's a fellow at the Harvard Kennedy School. For over 30 years, Paul has been deeply involved in monetary policy, market supervision, and financial stability policy, notably serving as a deputy governor at the Bank of England and chairing an impressive list of international committees. In my view, he's truly among the most compelling thinkers of the last 2 decades on all aspects of monetary policy and financial stability policy. And we're very fortunate we have him here with us today for an interview. Especially relevant to our theme at the SOMC meeting, in 2018, he wrote a phenomenal book called Unelected Power: The Quest for Legitimacy in Central Banking and the Regulatory State. If you haven't read it, I urge you to do so. So, Paul, yes, a little advertisement, Princeton University Press. So, Paul, my questions are in fact related to some important themes in your book. You emphasize the danger of elected officials relying ever more heavily on central banks to undertake what is really the responsibility of the fiscal policy authority, the Congress in the case of the US. So, in fact, following up on some of the themes we heard in the previous panel, my first question has several parts. First, how much do the Fed's new credit facilities that were put into place in response to the pandemic to provide risky loans to private firms step over that line into fiscal policy? Second, and somewhat more broadly, what can the Fed do to dampen expectations that it's now a permanent and significant fiscal actor? And third, what might all this mean for the Fed's future ability to run an independent monetary policy?
Well, Debbie, first of all, thank you very much for inviting me to do this, and to your SOMC colleagues. I've been following the SOMC for, gracious, as long as I can remember. And greetings to those of you watching, and especially to the central bank office holders and staff who are watching, because I know that you have a difficult job, especially right now, and it's going to remain very difficult for probably many years. I think there are 2 ways of thinking, 2 ways into this debate, Debbie, probably more than 2. One is, in its actions in the spring, the Federal Reserve has taken us another notch in, if you like, the Greenspan put, the Bernanke put, Yellen put, now the Powell put. And I have absolutely no doubt that that affects market behavior and affects the allocation of resources. And that's not to say that some kind of response wasn't needed, but I think it opens up a whole debate about, are there other sectors of the financial system and beyond perhaps, which need to be made more resilient? Because the dislocation in the Treasury market, and actually in London in the government bond market there, was indicative of a fragile, badly functioning market. So many commentators in the last few months have said, oh, the Treasury market is the most liquid market in the world. That shouldn't have happened. I think you shouldn't start with a proposition that it's the most liquid market in the world. It just is sometimes. The second way into it is that the stately dance between elected power and unelected power has taken a further turn. I mean, we should have no doubt that we live in a period where democratic power has retreated and unelected power has filled the vacuum, whether it be the Supreme Court or the Federal Reserve. And this is true in, this is probably in central banking, it's probably most true in the euro area. It's true in my country, the UK as well. And we should be deeply worried about this because it's not easy to see a way out. And this was the point that Charlie was pressing just now, which is that if you have two actors, one of whom has a reasonable set of powers, the central bank, but also a statutory objective, so legal duties, and the other power, the other authority, the fiscal authority, has potentially a very extensive set of powers subject to constitutional constraints, but no statutory objective, only an incentive to manage day-to-day politics and get re-elected, then the elected power can sit on its hands, knowing that the central bank will feel compelled to fill the vacuum and stretch its role as far as it needs to protect, in this case, the American people. And there can be no doubt that they needed protecting in March and beyond in order to get cash to businesses and households. If I could say two other things on this. So I think people should be surprised that the various Fed facilities weren't announced earlier. I did that kind of thing at one point in my career. I'm not sure that we ever announced a facility which we didn't know exactly what we were going to do. But most importantly, we knew what the purpose was. And a number of the previous panel speakers touched on how little some of the facilities have been used. But maybe they were designed to be a backstop, and maybe they've worked really well. And even if they weren't designed to be a backstop, maybe they've turned out to be a backstop. But it makes a difference. The key ingredient of good policy making and good policy execution is being clear about what you're trying to do. And then there's Charlie's question about, should all of this be handed over to the Treasury at some point? And the answer is broadly yes for some of the facilities, to the extent that decisions are being made about credit allocation, about who should fail and who should survive in the business sector. Those aren't decisions for unelected central bankers. So these are deepish waters, and the Federal Reserve is going to need to navigate its way out of them I suspect it will take a number of years, but the sooner they start articulating that challenge, the better.
Great. So let me turn to a related question. This time on some of the specifics of what the Fed has also done. Their balance sheet has ballooned after the 2000-2008 financial crisis. It kept growing after that instead of shrinking as some of us had hoped it would. And then it grew notably larger in recent months during the pandemic. So that growth was made possible in large part by the relatively recent granting to the Fed of the ability to pay above market interest rates on reserves. I'd like to hear your views on the appropriate size of balance sheets and on the ability to pay interest on reserves. What are the most important considerations about the risks in your mind, particularly as they relate to governance?
So I think the appropriate size of the balance sheet is the smallest possible size consistent with delivering on the statutory objectives, which may be quite big. But if you're sitting in those chairs, you shouldn't be trying to optimize you feel better if the bigger the balance sheet is, because then you'll start to think of all sorts of ills in the world that you can cure with your vast balance sheet and powers. That's the first thing to say. The second thing to say is, as maybe some people that are watching might remember, I initiated, and my incredible then team executed, the Bank of England introducing interest on reserves at the policy rate well before the last crisis. It wasn't done under duress. And the reason we made that move, very much with the support of Mervyn King, who was governor at the time, is that I and others wanted to get away from a system of reserve requirements for a whole series of reasons, which is that they're desperately confusing in terms of how you think monetary policy works. They get entangled with prudential liquidity policy. And I wanted to remove the tax but then we allowed the banks to choose what level of, each bank to choose the level of reserves it wanted to target between one monetary policy meeting and the next. But, and here's the crucial thing, of course, once you pay interest on reserves, you have three policy instruments. You have the policy rate, the size of your balance sheet, and also the composition of your balance sheet, or at least you can give yourself those three instruments. And this is not a cause for remembering Timberg and thinking, ah, gracious, we've got three instruments, we can have three objectives, and inventing them for yourself. I think parsimony in all of this is absolutely vital. But I don't myself think the Federal Reserve problems revolve around paying interest on reserves. I do think, and this would be for the aficionado only, that the problem of the market rate being below the policy rate is a problem rooted in certain of the banking practices and who banks with the New York Fed. And that could be, I think that could be cured, and they've heard me say that to them for about 15 to 20 years, but you know. And actually, I think people elsewhere in central banking chuckle sometimes cruelly at that problem.
Great, thanks. So I've exhausted my time. I want to turn the discussion over now to my fellow SOMC member, Charlie Plosser. Charlie is a distinguished academic macroeconomist, former dean of the William E. Simon Graduate School of Business Administration at the University of Rochester, and former president of the Federal Reserve Bank of Philadelphia. So Charlie, take it away. And unmute yourself.
You're mute, Charlie.
I spend a lot of time on Zoom these days, and I still can't work it all right. Anyway, it's good to see you, Paul, and thanks so much for being here. You know, you and I have had discussions on these topics many times over a number of years, and I think we share a lot of common themes and agreement on some things. I wanted to push you on a couple of items. One, just to continue along Debbie's line, and then a couple maybe shorter ones on monetary policy that you broached in your remarks. The first is one of the areas in which, the way I think about it, these boundaries between fiscal policy and monetary policy become most conflicted, or at least potential for crossing those boundaries and doing things, is in the lender of last resort function. And when a central bank has the role of a lender of last resort, it is very difficult and becomes difficult in sort of keeping that separation between doing fiscal policy and trying to do financial stability, if you will. Yes. So I would like to hear you speak a little bit about your views on not just the role of lender of last resort, but on how you structure that to protect either the independence of the bank or protects taxpayers, or how do you think about preserving some degree of separation and how that might work, or is it even possible?
Oh, I think this is a tremendously important question. I devoted a whole chapter in my book to this. I think it's quite extraordinary looking back over our time in central banking, Charlie, that so much was discussed around monetary policy and monetary regimes in particular, and there was so little discussion of lender of last resort. And yet most of the time, other than the aficionados, Fed watchers, ECB watchers, the general public aren't interested in monetary policy that much. But when lender of last resort happens, it's very salient in Congress and Parliament. And so it's a great mistake not to think about these things more deeply and devise a regime. First and central rule, do not provide liquidity assistance to a potential borrower who is fundamentally bust or unviable. Do not do that, and do not allow the perception to grow that you will do it. And the advent of modern resolution regimes since the last financial crisis frees central bankers from the dilemma that some of them have felt in the past. when in doubt about fundamental viability or bankruptcy, put the firm through resolution. And I think that central bankers, as lenders of last resort, should talk a lot more about the importance of resolution and the importance of it being credible, even where, as in the US, the Fed is not the resolution authority. I think neither those involved with lender of last resort policy, nor monetary policy, nor actually bank supervision, talk about this nearly enough as the vital, as the gateway that allows the Fed and other central banks to escape from this dilemma of providing liquidity assistance when actually an unelected body should not do so. And if the Treasury wants to do so, well, then it can, because it's an elected authority.
Great comments. You know, I think I used to say that sometimes resolution, at least when you have either resolution or bankruptcy, it throws it into a court with a set of rules. Although sometimes regulators can act very discretionarily, so to speak, in that framework. It would be nice if the rules of the game, so to speak, in this regard, were more articulate and more straightforward.
I think so. Just to elaborate a bit, Charlie, I mean, one of my principles for delegation to independent agencies is that, amongst many other things, they ought to articulate carefully the principles under which they're going to exercise the great discretions that they've been given by Congress, or in my case, Parliament. This is the word, Kate uses the word framework. And I'd like to see the Fed do that. And actually other central banks have gone a bit further on this. And it's, you know, this isn't something where virtue is at odds with institutional self-interest. Because when you come to do these controversial things, you really wish you'd set it out in a framework in advance so you can explain yourself. So, I mean, my underlying project is about marrying political values to rational choice institutionalism and institutional design. And this is a case where, you know, it wins every way. Set out the principles and the framework.
Well, that's why sometimes constraints are actually valuable.
Yeah.
They can and can't do. And the times central bankers and policymakers outside the central bank, the central bankers, since that's our subject,
yes,
sometimes they have to have the wherewithal or the power to say no.
Yes.
And that is helpful to them in putting constraints on some of this.
Yes.
Let me switch the topic to monetary policy a bit. One of the fascinating things I've read a little bit that you've written on about this is monetary policy, and Athanasios made this point a bit in his remarks. The Fed's mandate talks about the long-term growth of money and credit. And having sat at the FOMC for probably not as many meetings as you sat on the MPC, but 70 or 75 FOMC meetings, the old notions of money and credit as quantities are nowhere to be found in FOMC discussions. I wonder what your thinking is about whether that's a good thing or a bad thing. I think to put it in stark contrast, the crisis in 2007 and 8 and the crisis here in 2020 have resulted in very different behaviors of what economists call inside money. That is something like M2 as opposed to the monetary base.
Yeah.
In 2007-8, monetary base exploded, but M2 didn't. In March, or since April, or January, I mean, the Fed has pumped a lot of reserves into the banking system, and M2 has exploded. So the outcomes are very different in these two crises. So I'm wondering how you think about that and what role you think quantities should play in a central bank's decision-making process. I'm sorry that was so long.
No, not at all. I think this is a really important question. So, to be honest, when I was on the Monetary Policy Committee, which is going back a few years now, I would say that most of us thought that it was odd and not terribly wise that the Fed didn't look at the monetary aggregates. It did tend to look at credit conditions. And that wasn't just because it's in the law, although that's a kind of pretty overwhelming, a kind of trumping reason to look at the money and credit aggregates. And we actually not only looked at the headline aggregates, but we looked at sectoral decompositions of them as well. And they could be quite useful for both monetary policy and financial stability. And behind this, actually, the thinking at the Bank of England at the time, and I know Mervyn shared this view because he actually got me to read this stuff in the mid-1990s, was Karl Brunner and Alan Meltzer in some of their papers and the lectures that they gave in Italy, talked about it's a mistake just to think in terms of one interest rate. You actually, and a simple IS curve and LM curve, you kind of want another curve or a few curves in there for other rates. And for people that don't like quantities and prefer prices, one way of thinking about this is that the amount of money that you put out there, or the amount of money that's generated in the banking system, which of course are treated as safe assets, can affect risk premia. And so behind the view that money may matter, as opposed to just being a useful indicator, is that risk premia may matter, which invites a whole set of interesting questions about what determines shifts in risk premia, and do perturbations in risk premia have real effects? And those are not things where anyone knows the answer yet. But it's we would have thought that it's a mistake to say, well, we know that they don't matter, and therefore we're not going to look at them. Gillian Tett was good enough, the Financial Times journalist, was good enough to write in one of her books about how the Bank of England tried to look at the monetary aggregates and marry the monetary policy objective to the financial stability objective, obviously not with great success. But I still think that effort was worthwhile, and I would encourage the Federal Reserve to take an interest in money. And if it doesn't fit in the New Keynesian DSG model, which we used as well, then so what? Even if you use one central forecasting model, you have to be, and I'm kind of echoing Eddie George here, you have to be eclectic in what you look at, because what you're trying to do is understand what's going on in the economy and what's bearing on the outlook for inflation over the next 2 to 3 years. That's what monetary policy making is, and there's no one off-the-shelf model, however sophisticated, that gives you everything.
So let me ask one more question, and then I've got a couple of questions here. We can try to make this short. One of the consequences of the big balance sheet, and as you were talking about, how many tools does the Fed really have? Is the balance sheet an independent tool? Is the composition of the balance sheet yet another tool? And how does that relate to monetary policy, if at all? So the question is, and this becomes very important, is there's a modern phrase they call modern monetary theory now, which seems to believe that the balance sheet of the Fed is an independent tool and fiscal policy can use it for all sorts of purposes. And the notion that the Fed has kept that the balance sheet might be an independent tool, so is welcoming some of these notions. So tell me a little bit about what you think about modern monetary theory and what the central banks in general might want to do about this.
So modern monetary theory, of course, is a bit like the old Holy Roman Empire. But the important thing to say about it is that all good monetary regimes have to build in constraints. That what monetary regimes are ultimately about in constitutional republics is taking away from the executive the power to print money or the power to tax, so as to avoid, so as to step around the taxation prerogatives of Parliament, of Congress. And that function used to be served by the gold standard, and then the semi-gold standard, and then we didn't have anything at all in the 1970s. And independent central banks pursuing an inflation target I really do believe that they're a kind of corollary of the separation of powers. And therefore the central bank, the monetary authority, needs to be constrained. And modern monetary theory or any other theory needs to articulate clearly what the binding constraint is that prevents the abuse. And my point is not that modern monetary theorists wish to make that an abuse. It's that any system can be abused unless you build in the constraints and they are widely understood. I think whether onto the second part of the question, whether it's the Federal Reserve or the Bank of England or some of the other central banks, the question is how can they exit from quantitative easing and shrink their balance sheets in a timely way. For what it's worth, I applaud Governor Bailey's comment in the UK that they're now planning, as I understand it, when the time comes to reduce QE before they raise interest rates. And I think, broadly speaking, I think that is the right approach. Get the balance sheet back to a decent size when they can. And also explain, and I think a lot of rubbish is talked about the Fed in this respect. So maybe in hindsight, the Fed made some mistakes when it tightened policy a few years ago. But let it be said that they're going to make mistakes. The whole point about monetary policy is that you get a few goes a year and you get a few more goes next year. And it's an error correction system. It isn't like setting regulatory policy where once you've been through notice and comment rulemaking, that's your rule book for a number of years. And I think the Fed needs to articulate more that it's going to make mistakes, but when it can, it will get its balance sheet back to a normal size, depending on what the demand for reserves is. And I don't think it's so difficult when the time comes to find out what the new demand for reserves is. But there's a lot of trouble ahead before then, because until we have a vaccine, life is going to be difficult in the real world and therefore difficult for the monetary policymaker.
Great. Well, I think, Paul, we've filled up our time here. Unfortunately.
Charlie, it's great to talk to you. Great to talk to Debbie.
Thank you very much for being with us today, and wonderful comments. I appreciate it very much.
Good to see you all. Thank you. Bye-bye.
So it was a great pleasure to have Paul with us. It's a very always stimulating and thought-provoking, and I'm delighted he was able to join us. So I guess we want to move straight on to the last panel, which is the role and scope of monetary policy, accountability, and transparency. I think we have three speakers. Mike Bordeaux, who is a professor at Rutgers University, a prominent economic historian and macroeconomist. And so, Mike, we're delighted to have you with us as a fellow shadow member. We also have Peter Ireland from Boston College, another shadow member who is going to speak to us today, and we're delighted to him be on the panel. And finally, we have Mickey Levy, who's going to talk with us as well about the new policy statement and some work that he and I have been doing recently on that statement. So I think some of the themes that we've talked about in the last two sessions are going to reappear here. So let me start by welcoming Mike, and the floor is yours. Thank you.
Oh, great. Thank you. So I have some slides. Brad, can you put my slides up, please? Okay. So I'm talking about the Fed's corporate bond programs, and this I think dovetails very well with what Kathryn Judge talked about in the earlier panel. So the next slide, please. Yeah. No. Okay. Good. So the pandemic and the financial crisis and the recession led to great challenges for the Fed. The pandemic led to major declines in consumption, investment, and hours that would have occurred with a pandemic. It was really an endogenous response, but it was greatly magnified by the government lockdowns in March 2020. And I'm an economic historian, so I always like to think back about the Great Depression, which was something that we were thinking about back in March. And in the Great Depression, one of the ways that the big financial shocks that occurred, the bank failures that occurred, magnified itself through the economy was a mechanism that Ben Bernanke talked about called the financial accelerator. And in a sense, what happens is when you have declines in net worth and in collateral that for loans, and that this leads to default. This can lead to defaults, bankruptcies, and a collapse in credit. And a dynamic like that did occur in 2007 and 2008, and it started in the spring of 2020 because the corporate sector was hit by a collapse in sales, orders, and a disrupted supply chain. And you can see the stress in the next slide, please, in the spread between the corporate BAA bond rate and the Treasury rate. That's a measure that people look at to pick up financial stress. And this is looking at it over a very long period of time, and I'll talk about this a bit more. This all comes from a research paper I'm doing with John Duca at the Dallas Fed. And so what happens is when you have a crisis, that red line, that's the spread, goes up. Okay, the black line is a measure of the economy, the unemployment rate. Okay, so in response, the next slide, please. In response to the crisis, the Fed extended many of its facilities from the global financial crisis, but it added some new ones to shore up the corporate sector and small to medium business sectors, as well as state and local governments. And the reason it could do this is because of an explicit Fed guarantee against credit losses. And that was not the case in the global financial crisis. And there are many issues associated with that, which I'll talk about at the end. The key facilities were the primary and secondary corporate credit facilities, and they were done to support the issuance of and trading in corporate bonds at non-crisis spreads over Treasury yields. And the announcement of these facilities was associated with halting the rapid rise in the spread that I talked about. And if you look at figure 2, you'll see that next slide, please. Yeah, so what happened is that what the slide shows is that the black line shows what the economy did. And what the red line shows you is that once the Fed announced its facilities, bond facilities, the spread didn't go up that much. It didn't go up as much as it otherwise would have. Okay, so next slide, please. Okay, so this is what they did. The primary market corporate credit facility was the purchase of newly issued investment-grade bonds with maturities up to 4 years. And the other one was the secondary market corporate credit facility, which allowed them to buy exchange-traded funds, which is a type of derivative based on corporate bonds. And to shield the Fed from investment losses, both facilities were structured as special purpose vehicles, and they were funded by Treasury equity stakes of up to $50 billion for the first one and the $25 billion for the second. And the rest, okay, was to be funded by the Fed, and it could use leverage up to 10 to 1. So the Fed could really buy a lot of stuff. And the Fed's exposure to any one company was limited to 10% of an issuer's maximum historical outstanding bonds and 1.5% for the two facilities. Next slide, please. Okay, so there's a combined size limit of $750 billion on both facilities expiring at the end of this year. So the primary facility, the first one, can buy newly issued bonds at spreads over comparable maturity treasuries in a range based on credit rating and prevailing spreads over comparatively rated bonds at the time of the purchase, plus a 1 percentage point haircut. And for the second facility, it's not as explicit, but what they've done is they bought these ETFs when the corporate tread was as greater than 300 basis points, which was 100 basis points above the average in the previous 35 years. Okay, next slide. Okay, so what happened when they did this is that the corporate Treasury spread stopped rising on March 23rd, as soon as it was announced. This was well before the purchases started in May and June. And the amount of purchases they did, as was said in an earlier talk, were much less than the limits and the size of the facilities. So what this tells you is that it was a very strong backstop from announcing the facility. So the next slide, please. Okay, so what we did, John Duke and I, we have this model I'm not going to go through it. Don't worry. It models the spread between the yields on the BAA corporate bond and the long-term U.S. government bond. We have a model that has monthly data going back to the Great Depression and weekly data since 1971. And we account for major historical credit market shocks. Okay, the movements in the spread are highly correlated with the business cycle, which we proxy by the square of the unemployment rate, as was seen in Figure 1. So go to next slide, please. Okay, so this long-run model depends upon cyclical risk, which is the square of the unemployment, and a number of variables that shifted the spread. And the three historical variables we look at are the 1951 Federal Reserve Treasury Accord, which mitigated cyclical risk. We look at the Penn Central Railroad bankruptcy in 1970, which raised it, and then the Commodities Future Modernization Act of 2000, which increased the risk of corporate bonds. And the paper we did has all this stuff in it. So we estimated a co-integration model, monthly model, in the pre-COVID period, and we also had a weekly model, which goes from 1971 to 2020. And then we accounted for the Fed's intervention in the corporate bond market by altering the relationship between the unemployment rate and the spread. In other words, we artificially suspended this accelerator effect. And we also accounted for dummies, shock dummies from COVID. And what we found, so I'm just describe what we did, but I'm not showing you what we did. What we found is for the longer sample, going back to the 1929, is that the announcement of the Fed facilities prevented a 3.9 percentage point further rise in the spread, which is really big, okay? And the shorter sample was 2.2 percentage. And when we did a weekly model, we found that it prevented a rise from 3 to 3.4 percentage points from late April to early May. And this can be seen in Figure 4. Next slide, please. Okay, so it shows you it's the long run model is the blue line, and the short run model is the red line. So it shows you by announcing these facilities, it shows you how much the spread dropped, okay, based on this model. Next slide, please. Okay, and this shows you the weekly data. Again, you see how much it dropped. Okay, and then finally, next slide. Okay, so now, okay, then we get to the effects on the real economy, because you always want to know, so what? What's the effect on the economy? So we did this two ways. One is we estimated the effects of the bond spread on the equity premium on the Federal Reserve's model, where the equity premium works through a stock wealth effect. And we found that real GDP would be between 0.4 and 0.73% higher after 4 quarters, okay, assuming that the Fed, with this policy. Then what we did a second method, which is to use work by Gilchrist and Sacrajet in 2012, and that allowed for different channels of transmission through the wealth effect, through user cost, and credit availability. And so we looked at the effects of this announcement on their variable, the excess bond premium. And what we found was that the Fed's corporate debt intervention prevented real GDP from falling by 2.25 percentage points after 4 quarters, which would really be big if, say, the economy falls by 6%, okay, after the dust settles this year. It would have been 8.5% or 8.5% more higher. Okay, so what this tells us is it was a pretty successful tool in mitigating the financial accelerator channel. Okay, one more slide, please. Next slide. Okay, so the Fed's new facility, along with the new municipal bond and business loan program, they mark a major departure from early Fed practice, which only provided support to the banking system in financial crises. And since 2007, to some other financial intermediaries in markets. So the Fed has crossed a red line by directly supporting the non-financial sector beyond intervening in the money market. Moreover, the Treasury's guarantee that allowed the Fed to make this major change, that could pose serious risk to the Fed's independence. And the program could induce the non-financial sector to depend on Fed support in future crises and downturns, thereby having moral hazard effects. Next slide, please. Okay. So the Fed's new corporate facilities, despite providing upfront benefits, are not exactly a free lunch. Their true costs and hence the net benefits will depend on how they're eventually unwound and the extent of the moral hazard effects and the effects on Fed independence that they induce. So an important question is the following. Look, had they not done this policy, would the Fed's other more orthodox monetary and lender-less policies have done as good a job as this policy did? I think that would help address the question whether the benefits and costs of this policy, whether they were really worth it. Okay.
Thank you, Mike. We have to move on, and I appreciate. Well, I'm going to skip questions and try to get everybody in. So our next speaker is Peter
Thanks,
Eiler.
Charlie.
Peter?
Thanks to Kate Judge and Paul Tucker for joining us today. It's great to have had you both. Thanks, everybody, for tuning in. It's great to see you again. So I've prepared a little paper that goes along with my presentation this afternoon. It's called End Interest on Bank Reserves. And if you're interested, you can find it on my website, irelandp.com. But the basic idea is this. The Fed Reserve first received authority from Congress to begin paying interest on reserves during an emergency, the financial crisis of 2008. The Fed has continuously paid interest on reserves during the years since then, long after the original emergency ended, and shows no inclination to abandon the practice anytime soon. Interest on reserves, however, greatly interferes with the Federal Reserve's ability to use its traditional monetary policy tools to stabilize inflation during normal times. And what's more, interest on reserves, by allowing the Fed to purchase assets and make loans on a very large scale, threatens the efficiency of our private financial system and even places at risk the Fed's own independence. Interest on reserves may have been a useful tool during the emergency, but it's long outlived its usefulness since then. Congress should move immediately to withdraw the Fed's authorization to pay interest on reserves. Now, to flesh out some of the details, the easiest way to get your head around what are the problems associated with interest on reserves, where do they come from, is to go back and reconsider the reasons why the Fed began paying interest on reserves in the first place. That happened, as I said, at the height of the financial crisis in 2008, when the Fed needed to conduct emergency lending on a large scale in the wake of the failures of AIG and Lehman Brothers. Now, remember this. When the Fed makes an emergency loan, it credits the borrowing institution's account at the Fed with dollars in the form of newly created reserves. So emergency lending expands the supply of reserves in much the same way as does an open market purchase of Treasury securities with newly created reserves. Now, here's something that it's hard to remember, and to be honest, it's even a little bit hard to believe in a way, thinking back on it now. But in 2008, the Fed Reserve's biggest macroeconomic concern, as opposed to financial macroeconomic concern, was actually over the threat of higher inflation, not lower like it is today and like it has been since then. 2008 was the year when the world price of oil spiked sharply higher, threatening to push inflation overall up with it. So the Fed faced a dilemma. It needed to conduct emergency lending. It needed, therefore, to expand the supply of reserves. But it did not want the increase in the supply of reserves to fuel extra inflation. So interest on reserves was the way out. The idea was pay interest on reserves, augment banks' demand for reserves, increase the demand in lockstep with the increased supply. That way, the Fed could do emergency lending without creating unwanted inflation. So looking back on it now, these two aspects of the Fed's original decision to pay interest on reserves stand out. Number one, interest on reserves was designed to allow the Fed to greatly expand the supply of reserves without creating inflation. And then second, interest on reserves was designed to allow the Fed to conduct emergency lending on an unprecedentedly large scale. Now let's take those ideas and fast forward back to the present. What are the two biggest challenges that the Federal Reserve faces today? Well, one is now the threat of low inflation, maybe even outright deflation. Despite years of extraordinarily low interest rates, despite round after round of quantitative easing, inflation remains stubbornly below the Fed's long-run 2% target. Now, I've talked about this problem at previous SOMC meetings, so I'm not going to belabor the points today, but I am going to ask once again rhetorically, should we really be surprised that the massive expansion in the supply of reserves brought about, again, by wave after wave of quantitative easing has had frustratingly little effect on inflation when the whole point of interest on reserves was to allow the Fed to expand greatly the supply of reserves without creating inflation? Now, a second challenge, an even greater challenge, it seems to me, that the Fed faces today concerns mission creep and a potential resultant loss or erosion of its own independence. We can accept, for the sake of argument, that the myriad of asset purchase and emergency lending programs authorized by the CARES Act represents an appropriate and effective policy response to the disruptions in economic activity that have occurred beginning in the spring of 2020. We don't have to argue about that, but we could observe, as Charlie Plosser, as Paul Tucker, as a number of the panelists on the first session pointed out, those programs could have equally well been administered by the US Treasury. Instead, the Fed stepped up to play that role. That was a mistake. And the reason why it was a mistake is it let the cat out of the bag. Now it's obvious for everyone to see. Interest on reserves gives the Fed the ability to purchase any kind of asset and make any kind of loan in enormous volume on a moment's notice without creating inflation. The power is enormous and it's open to abuse. It's like Paul Tucker said earlier, the problem with systems that are not subject to constraints is that they're open to abuse. So Americans need to decide, do we want the Federal Reserve to go back to its traditional central banking role, responsible narrowly for managing the supply of reserves in order to stabilize the aggregate nominal price level? Or do we want the Federal Reserve to continue evolving into a colossal state-run financial intermediary, capable because of its enormous size and political influence of crowding out private competition, and subject to, let's face it, the worst elements of the American political system? Well, I know which choice I would make. That's why the name of the paper is End Interest on Bank Reserves. Thanks.
Thank you, Peter. Terrific. Nice job. And now we're going to turn to Mickey Levin. Mickey?
Yes, thank you, Charlie. Okay, so Charlie Plosser and I have teamed up to write a paper on the Fed's new strategic plan. And the title of our paper that'll be posted on the Shadow website is The Murky Future of Monetary Policy. So when we think back to 2012, the Fed's consensus strategic plan was a 2% target on inflation that was absolutely symmetric. And while the second mandate was maximum employment, even though the Fed emphasized that a numeric target for employment was inappropriate because it was affected by non-monetary factors. In the years that followed, the unemployment rate came down to a 50-year low. Inflation did average modestly below 2%, but inflationary expectations remained fairly well anchored to 2%. The Fed's concerns about the declining inflationary expectations and its impact on the zero bound led it to revise its strategy. The Fed was less concerned about the sub 2% inflation and its impact on economic performance, rather a decline in inflationary expectations that would push rates down closer to the zero bound and constrain monetary policy. So the revised statement, very quickly, flexible average inflation targeting involves a makeup strategy, lacks numeric numbers, and as we would emphasize, it's effectively asymmetric around 2%. The employment mandate is expanded to maximum inclusive employment with an explicit focus, as Athanasios mentioned, on the term shortfalls from that maximum inclusive employment. The Fed acknowledges the Phillips curve is flat, but Charlie and I would like to emphasize that it does not replace it with any framework for assessing inflation or how to predict it. The Fed provides no strategy for how it's going to raise inflation, and it presumes that it has credibility in managing inflationary expectations. I'll come back to that point. So in general, we think the Fed's new strategy statement lacks clarity and adds confusion, and it shifts reliance just totally on discretion without any guidelines or rules to achieve a broader objective, an interpretation of more broader mandates. And this can expose the Fed to politicization, and it could erode the Fed's credibility. And it totally leaves financial markets and the public confused about monetary policy. So when we think about the price objective, the Fed, its makeup strategy and its asymmetric approach to 2% lacks any type of numeric boundaries on what it wants to achieve. So the shortfall, the cumulative shortfall of the PCE price index from a 2% inflation since 2012 has been roughly 4%. Is the Fed's intermediate term inflation objective 2.5%? Would it allow 3% inflation for 4 years, which would be a catch-up? What is acceptable? The Fed does not let us know, and it's totally up to the discretion of the Fed, and it leaves markets wondering. Once again, this asymmetry, the Fed does not mention at all that if inflation is above 2% for any sustained period, that it would have a makeup strategy below 2%. So the 2% effectively becomes the floor rather than the average. Now, without a Phillips curve, the Fed's model for inflation is basically a strategy that hinges on inflationary expectations and its credibility to manage those expectations. But once again, it just simply presumes that it has credibility, even though it's never explained why all of its near zero interest rates and extensive quantitative easing failed to generate inflation of 2%. So it presumes it has this credibility, and its whole strategy right now, but also at the zero lower bound, if we were to have any bout of deflation, its whole strategy depends on its credibility that is presumed. So we think the Fed should focus as much on why it has failed to lift inflation and to consider other operating procedures, including interest on reserves, that may be helpful. Now, on broadening the mandate for employment, Keep in mind, Chair Powell has emphasized that employment is driven by demographics, education and skills training, health, and fiscal policy. Charlie and I would also add regulatory policies. But it's expanded this new mandate to include maximum inclusive employment and focusing on the shortfalls. And this is a touchy issue, but this inclusive objective is laudable. It's a desirable feature for efficient labor markets to have maximum employment for all individuals. But to the extent it's well beyond the scope of monetary policy, it's really problematic to include it in its official strategy statement. It very well could and probably is misleading the Congress and the public, and exposes the Fed to politics and may threaten its independence. Now, with regard to acknowledging the Phillips curve is flat, suggesting strongly that the Fed no longer believes that the unemployment rate is a reliable predictor of inflation. The Fed, along with abandoning the Phillips curve and its asymmetric approach to maximum inclusive employment, the Fed is suggesting, and certainly the financial markets and financial commentators are interpreting this asymmetry as the Fed has raised the hurdle for preemptive monetary tightening. And that's clear in financial markets, and only the Fed hasn't stated explicitly, but they certainly suggest it. And if so, this kind of downgrading, if you will, of the leaning against the wind policy seems to run counter to the Fed's focus on managing inflationary expectations. Once again, the Fed has not replaced the downgrading of the Phillips curve with any framework or model for forecasting inflation. And this leaves a very big gap, not only in its strategy, but in its communications. And what's so striking is the first Fed meeting in September, there were 2 dissents by FOMC meetings regarding interpretations about forward guidance and the flexibility. And then in Powell's press conference, a response to a question about inflation and employment, it just echoed the Phillips curve. And then also there's this issue of the SEP. So let me just conclude and say the strategy, the new strategy, it broadens the Fed's mandates, but it really doesn't establish the monetary policy tools or strategy for achieving those mandates. It's just too complex for what it needs to be, and there are a host of problems. And when we stand back and look at it from the current situation, the new strategy seems more appropriate as a near-term tactical plan, as with economic growth way below where it used to be, rather than a long-term strategy plan. And we think the Fed's going to run into problems and need to revise this new strategy once the economy normalizes. Charlie, you're the moderator, but why don't you follow up?
All right. No, you did very well, Mickey, and I think that we're out of time. I know people signed up till 4:45, right? Is that correct? No, we have until 5. I'm sorry. I apologize. So now we can. I'll be happy to take some questions that the audience might have, or fellow FOMC members would like to share. Let me start by asking Peter a question. Terrific thoughts and presentation. Paul Tucker talked about reserve requirements a bit. And so how do you think about that fitting into your reserve reserve. Is there still a role for reserve requirements, or how does that interact with your thoughts?
Well, today, reserve requirements interact in complicated ways with liquidity requirements. And even before the financial crisis of 2008, it became abundantly clear that just for clearing purposes, banks needed to hold a certain amount of reserves, independent of the old-fashioned issue of how many people come into a bank branch and ask for their money back on any given day. I don't have strong feelings, vis-a-vis should the Fed put reserve requirements back or not. In fact, I'm glad you asked the question, because Paul Tucker said something else about interest on reserves, which is, he said, I don't think interest on reserves in and of itself is a huge problem. I would actually agree. Point number one would be interest on required reserves doesn't really pose any problems for affecting the price level via open market operations and so on. So you could go back to a regime where there were reserve requirements, interest on required reserves, but just not interest on excess reserves. But again, the problem is not so much with interest on reserves per se, but an interest on reserves regime where there are no further constraints on what the Fed can do with its power to pay interest on reserves. So if we had a rule such as interest on reserves, but the Fed could only purchase short-term treasury securities, then I would say I don't have major concerns then with the regime of interest on reserve. It's interest on reserves in an environment where Fed Reserve officials, Congress, the public feel like the Fed Reserve has an outsized role to play in the private financial system. I think the combination of interest on reserves and interventions in the private financial system, that's the dangerous combination. That's when the constraints are gone and the system's open to abuse.
Great, thank you, Peter. I have another question from Mike. Someone in the audience has asked the question, how do you distinguish in your announcement effects or the effects on the spreads in your paper?
Okay. Can you hear me? Yeah, I can't.
Mike?
Yeah, okay.
You're on mute. All right.
I'm not muted.
Can you hear me?
Okay. Can you hear me now?
Yes.
Okay.
All right.
Mainly what we're picking up are the announcement effects, because in a sense, the Fed didn't do very much of these purchases. So, and the effect happened instantly before they even did anything. Okay, another question I got was about moral hazard. I think it is going to induce moral hazard. I said it might, but there's a pretty good chance that it will. Thank you.
Okay. Mickey, I think you saw Andy was asking the question, well, this is really about hopes and aspirations. And this new strategy, and not much about policy or strategies. Do you agree with that? And if so, I'll let you answer that.
Well, yes, I agree with Andy. In fact, in a paper that was presented by Rich Clarida after the Jackson Hole meeting, he referred to 2% inflation as an aspiration. And so once again, this issue is inflationary expectations have been pretty well anchored to 2%, even though inflation's been a touch below it. The Fed has never explained why all of its expansive monetary policies didn't generate 2% inflation. And now it has this aspiration to have this makeup strategy with above 2% inflation without defining at all the parameters on it. And its rationale for that is it wants to lift inflationary expectations and inflation, and it presumes that it has credibility to do so. And it's all kind of, Charlie, you and I have discussed this, it all is kind of a circular argument that it just doesn't, it just boils down to more Fed discretion to do what it wants to try to achieve a broader mandate. And what you accomplished at the Fed in 2012 with a 2% numeric target that everybody knew it was a target and was symmetric kind of goes out the window, but it's not replaced with anything material in terms of a guideline for financial markets or the public. And so it's hard to see how it's really going to contribute positively to economic performance or monetary policy.
Thanks, Mickey. I'm going to just elaborate just for less than 30 seconds about this, because what the Fed wanted to do in its 2018 review it announced was it saw an opportunity to review its tools, strategies, and communications in an integrated fashion to put together a framework for monetary policy. And I think that Peter gives a good example is that the Fed didn't really review its operating regime or the tools it uses to achieve its objectives. It continued to say the funds rate is our instrument, our tool, although the funds market hardly exists, has been decimated and it really doesn't operate very much. Why is that still the right tool? And as Peter pointed out, the operating regime, which includes interest on reserves, a huge balance sheet, a floor system, it didn't question at all that framework as to part of why it might be true, as Peter suggested, they might have something to do with the fact that it was not able to hit its inflation target or was below it. Now, whether that's the right answer or not, it certainly sounds good, and I think it's worth pursuing. But the Fed didn't look at any of that. The Fed didn't do any of that. And so this really wasn't a very extensive review. And certainly I was disappointed about it unwilling to go beyond just its usual thinking on how its tools and its operating regimes affect its inflation success, if you will. There are some other, Mike, there was another question for you somewhere.
Yep. Yeah. Okay. So the question was to have me elaborate on the costs that could possibly outweigh the benefits. So the first cost is really that, okay, is the Fed put being extended that we've talked about earlier in this conference to the corporate sector? And traditionally, the corporate sector has not been something the Fed was worried about, or the Fed was worried about it, but the Fed really did much about, and it was always in the province of the Treasury and the fiscal authorities. So what's happened is we've expanded the fiscal credit policy of the Fed's just been expanded to take over a very large sector which has a lot of risk. And so what this means is that if you take big risks and you lose, that the Fed's going to pay for it. This is a risk that we face. Now you could say, sure, there was a pandemic, it had nothing to do with it. But once you've done it in the circumstances of the pandemic, it can be done again. That's the worry that I have, that once you've opened up the Pandora's box, it's hard to get back. It's hard to get everybody, all the genies back into the box. Okay, that's my main worry. And this, of course, affects the Fed's independence because it's not in its mandate. Its independence. If it follows the policies it's supposed to follow, its mandate, okay, and is credible in following these policies, then its independence is secure. But once it crosses this line and moves into lots of other areas that have nothing to do with monetary policy, okay, then it becomes more like the Treasury and it loses its independence.
Charlie?
Peter, go ahead.
Just a quick point. Debbie Lucas reminded me of something I should have said earlier, which is another peculiar aspect. Again, the problems with interest on reserves come out most clearly when you examine the details. And another peculiar and costly and damaging aspect of the way interest on excess reserves has been implemented by the Fed is actually not only paying interest on reserves, but paying interest on reserves at above market interest rate, because that's clearly a subsidy. It's a subsidy to the banks that are holding the excess reserves. It's a hidden subsidy. It's not a subsidy that anybody in Congress ever thought thought directly about and discussed. And it's happening on a large scale. So thank you, Debbie.
We have an audience question about, and Peter, I mean, everybody might have some opinions about this, about negative interest rates as an alternative tool. Andy talked a little bit about this in his session as an alternative tool to QE and so forth, or average inflation targeting and makeup strategies. What's the view among you folks about negative interest rates? And the Fed seems to be shy of them, but I'd like to hear your views as well.
I was pointing to Mike Bordeaux because of the three of us. He's done the most.
You've written about this, so sure, okay. Mike.
Okay, rephrase the question, please.
So, an audience question was about the view of negative interest rates as a policy tool. Much like many European countries have done, it's an alternative to some of the strategies that the Fed has adopted, either QE or now this inflation makeup strategy as a way for dealing with the zero bound. What's your view?
Okay, so Andy Levin and I wrote a paper last year on central bank digital currency, which got a lot of attention. At the time, there wasn't much interest in it, but now it's been very, very popular. So what we argued then was if you had central bank digital currency, in other words, people could have accounts at the Fed, but they were digital, okay? And if the Fed could do this, and if it paid interest on this currency, okay, it also paid interest on reserves, which the digital banks could have digital deposits and they could hold reserves at the Fed. Okay, and having central bank digital currency would allow them to get around the zero lower bound, and they could raise or lower interest rates to always, clear any excess demand or supply for money. And so our argument was you need central bank digital currency that would make negative interest rates really work, because the real problem is the zero lower bound. And as long as as long as people have cash, okay, large numbers of people are using cash, it's very hard to pay interest rates below that because people will shift into cash. So our proposal was to link the two things together, CBDC, negative rates, and allowing interest rates to move up, down. Okay, and this completely agrees with an argument that Marvin Goodfriend, a former member of this group, made. And we think that this would solve the problem and avoid having to use QE and do all the silly things that the Fed does.
Great.
I think that anybody else want to briefly comment on that?
Charlie, can I just make one point? Okay, Chair Powell, at the lead off of the Fed's big conference in June of 2019, setting this new strategy in motion, said the Fed's biggest concern is decline inflationary expectations in the zero lower bound. But at the same time, while he said negative rates don't seem appropriate at this time, the Fed has also acknowledged that its QE2 and QE3 were not nearly as effective as the Fed had earlier advertised them to be. And this really puts the Fed in a bind and highlights this whole new strategy and kind of is it just tactics and more discretion, or is it really a strategy to achieve its new mandates?
Great. Thank you, Mickey. I think we're now out of time. I apologize for the faux pas earlier. It's after 5. We promised people they would be out. I want to thank Mike and Peter and Mickey for their presentations. I want to thank all the people who have been online and joined our conference virtually. It was great to have you present, and we appreciate your time and your interest. So this concludes our SOMC meeting for this fall, and we'd like to wish everybody health and happiness, and be safe. And thank you all for attending. Appreciate it very much. And thank Tucker and Kathryn Kate Judge. We appreciate their presence as well. So thank you all, and good evening.